David Zervos is here. He's the chief market strategist at Jefferies and a CNBC contributor. Also with us are CNBC senior economics reporter Steve Leisman and Michael Cuggino, president and portfolio manager of the Permanent Portfolio family of funds. But we should mention, Michael, not only five-star fund, you're up 4% this year, which is not too shabby in a market environment like this. So welcome.
Thank you.
Is that all gold? What accounts for that? It's not. You have a lot of different things in there.
No, it's diversification. Gold and silver have definitely helped, but also the fact that we're not heavily overweighted in technology stocks. We're very diversified equity-wise. Our bond holdings have done well. We've been shorter duration, intermediate duration, high-quality names. So all of that's contributed.
So when these tariff headlines are flying around and the market keeps doing what it's doing, what does that make you think? Are you getting extra more defensive, or do you stick with what you have and think we're going to ride this out?
No, we're not surprised by any of this. And in fact, I think investors are getting way too wrapped up in the daily headlines. It's like a daily herky-jerky motion thing. And they should just kind of let things ride out. There's a lot of information that still needs to come to play for long-term investors. So we haven't been doing a lot, honestly, because our base case is still that there was going to be some hiccups in this transition from the new administration and the new economic policies. And that seems to be playing out. And what you do is you try to find opportunities when you have crazy days and take advantage of them. Yeah,
so Dave, that's kind of a good peg to bring you in on. You're sitting there in Washington, which is being blamed for much of the market volatility that we're seeing. Do you think it's warranted? I mean, look at just the headlines the past 30 to 60 minutes.
You know, Kelly, I think there are some things that are different than many people had expected. And the most, I don't think people are that surprised, to be honest, or shouldn't be that surprised, as Michael said, with tariffs, with immigration policies, or even the dereg policies, which we were all very excited about. All that is really going as scripted. The thing that's been different, and I think investors have had to adjust to in the last few weeks, is the speed with which the administration is going down the DOGE path. How much spending is being cut? How many people are being let off? You just led with a story about the courts forcing the federal government to rehire probationary employees that they fired. So I think the speed, the vision of that chainsaw with Elon Musk on it just got the markets a little bit nervous about how quickly we transition to a more private sector driven economy from an economy that had been heavily reliant, and according to this administration, too reliant on a public sector that was very heavy and had become very heavy over the last administration. One could argue even over the course of the post-GFC world.
That's all well and good, Dave, but what do you say to investors about tariffs?
You know, I say that it's really, in the grand scheme of the U.S. economy, which is a domestically driven economy, it's just not the number one issue. It's one we can analyze. We can look at specific industries and go, wow, wine might go up a lot if you buy Bordeaux's and Burgundies, or it might have an effect on this specific car that's got a lot of parts that come from overseas. But the really big picture U.S. story is not going to get driven by tariffs. It's going to get driven by deregulation, lower cost of doing business, and this transition to a more private sector driven economy over the long run that I think will be more efficient and more productive. The short term is really going to be guided by the speed with which they do this. And if they go really fast, you're going to get bigger bumps than this. And that's just what we're all grappling with now. I like the way Michael spoke about his portfolio with at least some hedges in fixed income. We've had our risk parity bets on this year and last year, and those have been very helpful in riding out a bullish risk asset theme, because you have this overweight hedge that gives you expectations of rate cuts or expectations of lower rates down the road, which I think are going to come either way, depending on whether they come sooner rather than later, depending on this speed of DOGE.